Dr. Gale, you had talked about three criteria as it relates to testing growth, fairness, in a fiscal test, all of which this tax cut failed. Is there any tax cut that actually pays for itself?
There certainly are situations where reducing a tax rate could pay for itself. For example, if you had a 95% tax rate on some form of income, you reduced it to 90%, you would likely end up raising revenues because you're doubling the after-tax return there from 5 to 10 cents on the dollar. But none of that really applies. I mean, we're way over on the other side of the so-called Laffer curve.
Mark Zandi from Moody's Analytics, a former advisor to John McCain, had said that the best case scenario for a corporate tax cut is a return of 32 cents for every dollar that you give away in a tax cut, corporate tax cut. So that would say to me that your return on investment from that tax cut is minus 68%. Is it a fair characterization?
We'll clearly get some revenue offset from corporate tax cuts. There'll be some. We won't lose 100%, but it really depends on what part of the corporate tax system is cut. Cutting the rate, which is what happened in 2017, is the least efficient way to generate new investment, because a huge amount of current corporate investment is income from investment in the past. And so cutting the rate doesn't do anything to boost investment in the past. You get a much bigger bang for the buck if you give incentives to new investment. So for example, if we raise the corporate rate to 25 or 28, but also moved all the way to expensing, we would get more investment and more revenues than the current system.
When this corporate tax bill was originally made public as a proposal, the White House Council of Economic Advisors had stated in a formal communication to the House Ways and Means Committee that this proposed tax cut would increase household income by between $4,000 and $9,000, and this would be recurring. This would happen on an annualized basis. I don't have any evidence that materialized. Is there any evidence that there's been an increase in household income to the extent to which the White House Council of Economic Advisors had stated that it would?
Well, the CEA was very careful not to specify a date by which that would happen. So it's, I don't think anyone expected it to happen in the first year, but they expect income to rise by 4,000 to 9,000 above what it otherwise would have risen. I find that extremely unlikely, and I'll refer back to the CBO numbers I mentioned earlier, that after 10 years, national income will only go up by 0.1%.
How could, who's the Council of Economic Advisors?
The White House group of economists.
And that would include perhaps the Treasury Secretary? No,
no, sir. The CEA is a set of staff members. There's 3 members of the council. Kevin Hassett being the head of the council right now, and I think there's about 15 or 20 staff members that they work for the White House.
Okay, how could they be so far off?
Their document cites the literature in a number of ways, but I and others, when we look at the literature, reach different conclusions than the CEA does.
Who is the author of the literature?
There are numerous articles.
Okay, so they're economists. They're looking for literature, presumably from other economists. So I'm just kind of curious as to what the Council of Economic Advisors, who would they defer to in order to inform them of a decision that they have to make a formal report on the White House Council of Economic Advisors stationery to Congress?
Normally, they would look at the academic literature, but it's not always easy to interpret these numbers. For example, there was a study in Germany that half of the corporate tax is passed on to workers, and people try to use that in the United States, but it's not a valid comparison because the governmental units in Germany are much smaller than the overall size of the U.S. economy, so the amount of shifting of the tax will be different.
I know my time's expired, but let me just say this. So, the White House Council of Economic Advisors, who make a report to Congress, may have made reference to the literature on economics that was established by economists in Germany?
So they cite a lot of the literature. My point is, I think that I and others who've looked at the same literature would reach different conclusions from it.
I yield back. Thank you.